Hi, this is Ian Goldtrum. I'm a lead portfolio manager with the Foward Real Estate Long Short Fund. And I want to give you a quick update on the fourth quarter as well as summarize what happened in the year 2014 overall as well. The fourth quarter continued what had been a very strong performance for the fund and the sector through the end of the third quarter. In the fourth quarter alone, the fund was up some 10%. And that rounded out the year 2014 at about 24% for the year. And we really want to caution investors that that is not a typical year in the REIT sector. Over 30 years, over very long periods of time, REITs typically do about 11% per year. And so a year where you get 24% is exceptional. And that really is the case because of the recovery from the crisis that we saw in 08 and 09. REITs became very cheap at that time and really have enjoyed quite a run, both on the ground with the assets. Real estate as a sector has done very well post-crisis. And the equities that the companies that we own shares in the fund that own these assets on the ground have also performed very well. And now we've arrived at a point where a number of these stocks are quite pricey. And the wonderful thing about this strategy is it can, in fact, participate in shorting some of these names that are particularly exceptionally highly priced. And we hope will hedge the exposures that we have on the long side. The fund will always be net long and remains so today. The performance that we saw last year, as I say, is not likely to be repeated. And we've arrived at a point where we think over the next 1 to 5 years that this hedged approach to owning real estate is going to be particularly important. Over the last 5 years, really, 2009 through 2014, or the year-end 2009 through year-end 14, we saw quite a run in these stocks, and really you could have made money owning any of them in many ways. And now we've arrived at a point where, as I say, a number of them are quite pricey, and we think the approach of being long and short and the ability to sell calls that the strategy has against existing long positions that are up a lot, a blended approach to capturing value in the sector we think is particularly important now, as opposed to really you could have been long only over the last 5 years, and as I say, done very well. So this is a moment in time where a number of these companies on the ground are seeing very strong rent growth. The good news is there's a remarkable lack of new supply. Usually at this point in real estate recoveries, you begin to see a lot of development. And we are seeing that in a couple of markets. But the reality is nationally, where the footprint of these companies is invested, if you will, these companies are very well positioned from the standpoint of being able to raise rents because there's very little new competition in their markets. There's very little new supply of newly developed space to compete with the existing inventory. And so we see continued rent growth, continued cash flow growth. And if the economy continues to recover as it has, even if that growth rate slows some, we've seen quite exceptional growth in the economy in recent quarters. If that growth rate slows some but doesn't go back into recession, the setup for these companies is that dividends will grow, the net asset values or breakup values of these companies will continue to grow, and the fund should be able to deliver low double-digit returns over the next couple of years. And certainly there will be periods of volatility, and again, I think a hedged approach is uniquely positioned to benefit from that volatility. And we appreciate your interest in the fund and look forward to communicating again in the future.